Okay, hello everyone and welcome to today's session where we're going to be exploring the fast-paced world of scalping. But before we jump into this, I just want to quickly kick off today by clarifying, for those of you who don't already know, Orbex is a fully regulated online broker. We founded in 2009 offering currency, commodity and equity index trading. So for those of you who aren't already account holders, if you're looking to connect to the financial markets, then you can open accounts with us and join our happy base of clients. And we also have a special announcement today, which is that Orbex has now eliminated commissions from all account types. So Orbex still offers traders ultra competitive fixed and variable spreads, but now without the cost of commissions. And this allows for more transparency in calculating trading costs. So these new account types have come about as a result of intensive research and have been developed based on customer insight and an increased demand for flexible investment products. So to quickly summarize, all accounts will now have access to leverage of up to 500 to 1, swap-free trading, free VPS hosting, industry-leading trading signals, and trading across all devices. So again, just a little announcement there for those of you who weren't aware that Orbex is actually a broker, and then also a special announcement that we've just released accounts without trading commissions. So back to today's topic then, scalping. Now, scalping is an area of Forex trading that always appeals to new traders because of the potential to make big profits quickly. However, with the high level of reward also comes a high level of risk. So it's really important that you take the time to properly understand scalping before applying it to live markets. So in today's session, I'm going to explain exactly what scalping is, as well as looking at some basic strategies to get you started. And as ever, we're going to take things nice and slow and steady, make sure that we cover everything in detail so that you're really comfortable with it. And as always, if you have any questions, please just write them in the chat function periodically, and I'll stop as we go along to answer them. Okay, so first of all then, what is scalping? So instead of referring to a specific strategy, scalping is actually referring more to a way of approaching the markets where the trader is looking to exit trades as quickly as possible with the intention of capturing only very small moves in price. Okay, so for those of you who are in the swing trading webinar that we did a couple of weeks ago, you know that swing trading on the higher time frames is where we're looking to take trades that can last anywhere between a day and several weeks, and we're looking to capture large percentage moves in price. However, a scalper is looking to hold positions for anywhere between a few seconds to a few minutes, and typically only looking to capture really small pip moves, such as moves between 2 and 20 pips. Now, as scalpers are only targeting such small pip gains, they typically trade with a higher position size than a swing trader would. This is to make the trades more meaningful. Now, the increased position size brings the potential for big profits quickly, however, traders need to be careful as they can expose themselves to large risks trading in this manner. And again, this is why it's extremely important for traders to focus on risk management when using scalping methods. Now, due to the nature of scalping, it's only suitable for those traders who have plenty of free time to focus on the markets, as it can be quite an intense and time-consuming task. Now, despite the fact that trades are only held for very short durations, scalpers typically spend a great deal of time watching the markets, waiting for trades to set up. Okay, so because they're focusing on the lower time frames where the volatility is more pronounced, okay, I'm sure that some of you have seen how the market moves on the 5-minute charts and the 1-minute charts instead of the daily charts, where the moves tend to be a lot quicker and a lot bigger relatively. So scalping is a task which requires a high level of focus. It's a way of approaching the market which requires a high level of focus. So again, this method of trading isn't really available to those traders, for example, who are at work all day or busy with families, okay? Again, it requires a lot of time and a lot of focus, but it can be incredibly rewarding for those traders who have the time to use this approach. And also, for traders who prefer to take a more active approach, okay? Because some traders prefer to set trades and walk away. Now, we talked about this in the swing trading webinar. Some traders like setting trades and leaving them to work out over a number of days and weeks. However, other traders prefer to take much shorter trades with quicker outcomes. So other traders prefer scalping because of the relatively small stop sizes that are required. So as we discussed again in the swing trading webinar, when one is trading on the higher time frames, it isn't uncommon for trades to need to have stops of 100 pips or more, and this can be quite daunting for some traders. But the idea of having a stop loss that is only 5 or 10 pips is very appealing, especially to a lot of new traders who are just getting to grips with trading the markets and just learning to accept losses as part and parcel of this business. So the benefits then of swing trading, just to summarize, you get a much more active involvement with the market. You can make profits much more quickly than swing trading, and you can also trade with very tight stops comparatively. So again, as we've mentioned, scalping is really an approach instead of a specific strategy. However, there are some classic strategies that scalpers tend to use, and we're going to take a look at some of these during this session to give you an idea of how you can approach the market in this way if you aren't already familiar with scalping. So one of the first strategies that we're going to look at is scalping Fibonacci retracements on the 5-minute time frame. Now, Fibonacci levels can be powerful reversal points in the market, and hopefully for those of you who can remember the Fibonacci sessions that we did, if you can't, just make sure to take the time to go back over those. Essentially, the Fibonacci retracement tool helps us to measure swings in price to identify key reversal levels based on the mathematical ratios underpinning the Fibonacci number sequence. Now, this is a common tool that you'll find on the MT4 platform, and it can be a very powerful analytical tool for helping us find these levels. And these levels often tend to act as strong support and resistance in the market, and scalpers traditionally love to target these levels, looking to make profits on the quick reactions that they often generate. So let's take a look at some examples now, and I'll walk you through this method. Okay, so you can see in this example that we have price making a sharp bullish move initially on the day. Okay, so you can all see this really sharp upside move. We get a series of green candles showing us that buyers are in control, taking price steadily higher. And then once we get to this point on the day, you can see that we actually start to correct lower, and we get this series of red candles, bearish candles, showing us that sellers have taken over. So on a day like this, once we identify a strong directional move, in this case, a strong bullish move, what we're then looking to identify is a subsequent correction in the market. And then once this correction starts to occur, we want to take our Fibonacci tool, our Fibonacci retracement tool, and measure the impulsive swing. So in this instance, we measure this first bullish move. You can see from the low to the high, and then the tool automatically plots on our key Fibonacci levels. Now, although all of these levels are key, in this method, we're only going to focus on the 50% retracement, which is this one here, okay? And essentially with this method, what we're looking to do is buy the 50% retracement, okay? So we're looking to buy the 50% retracement as price tests it from the top side. So we've had our bullish move to the top side, price is corrected lower, we apply our Fibonacci tool, and as price retraces into that 50% retracement level, we're looking to buy. And then what we want to do is place our stop below the 61.8% retracement level, which is this next Fibonacci retracement level here. And then all we're looking to do is target a move back up to the 23.6% retracement level here, okay? So this is a very simple 2-to-1 risk-reward strategy that we can apply. And what we're relying on in this strategy is the market's natural dynamic of expanding and correcting, okay? But instead of setting big trades on the higher time frames, which will play out over a number of days and weeks, we're just looking for really quick intraday setups, okay? So we're on the 5-minute time frame here. This is the move over 1 day. And as I say, you can see that we've got this big bullish expansion to the top side. Price then corrected lower. We apply our Fibonacci retracement tool, and we're simply looking to buy as price retests the 50% retracement level. Our stop is below the 61.8, and then our target is just to move back up to the 23.6% retracement level, which gives us a roughly 2-to-1 return. So this is a really great, really simple, effective strategy that a lot of short-term intraday traders apply. So again, another example here of this strategy. And you can see that once more, we had this really explosive bullish move to the top side. Okay, so you can see that our directional move on the day initially was to the top side. So the market opened up, we were chopping around in this range, we then got this explosive move higher, we moved all the way up to the highs of the day before starting to correct lower. So once we see this correction starting to occur, what we want to do is get our Fibonacci retracement tool, apply it from the low to the high, and then once again, we're looking to trade at the 50% retracement level. So you can see that I've highlighted here in the orange box the period when price tested the 50% retracement level, allowing us to get long. And once more, our stop simply goes below the 61.8% level, and we're just targeting a move back up to the 23.6% retracement level. Now, the great thing about trading in this way is that we can be really opportunistic and look to take profits quickly, okay? Because you can see that ultimately on the day, price actually reversed and traded lower. So if we've been looking to hold this trade as a day trade, as a swing trade, and looking to hold this over a number of days, we would ultimately have been stopped out as price, after a quick rebound high here, eventually rolled over and traded lower. However, because all we're doing is scalping and looking for such a quick reaction, we can still make good money. And so, while we're only targeting a move to the 23.6, you can see that we achieved our profit target really quickly here, okay? And we're out of the market with our profit before price rolls over and trades lower. So this is one of the benefits of scalping, where swing traders need to take a broader directional view on the market, and they need to get an idea of where price is likely to head over the next few days and over the next couple of weeks. A scalper really only needs to concern themselves with where price might be going over the next few minutes, okay? And this really is a fantastic way to trade. As I say, if you have the time to apply to the markets and you have the focus, then this is a really great way to trade, and you can benefit from really quick reactions from technical setups in this manner. Okay, so the two examples that we've just looked at there are quite clearly bullish examples where we've been buying, but the trade works in exactly the same way for bearish trades, so where we're looking to set short entries and sell. So in this instance, looking at this example, you can see that the directional move on the day, so the impulsive move, was this large bearish swing here. Okay, so the market opened up, we were chopping around in this range, and then we collapsed lower. So this was a very volatile day, and we got a really sharp move to the downside, giving us a large bearish swing. So once price bottoms out here and starts to correct higher, we once again go in and apply our Fibonacci retracement tool. Jeff, yeah, that's a 5-minute chart. So this time, because we're applying a Fibonacci retracement to a bearish swing, we apply the retracement tool from the top to the bottom. And then again, the key level that we're looking at here is the 50% retracement. So we're not looking at any of the other Fibonacci levels, we're just focusing on the 50% retracement. But this time, however, because we're looking at a bearish example, we're not going to be buying the 50%, we're going to be looking to sell. So you can see that price pops back up here, tests the 50% retracement, allowing us to get short, And then again, we're putting our stop behind the 61.8% retracement, which this time is above the 50, okay, because we're looking at the market from the other side now. We're looking at a bearish swing. So we enter our short position at the 50% retracement level. We put our stop above the 61.8% retracement, and then our target on that trade is a return to the 23.6% retracement level, okay? So exactly the opposite of what we saw, exactly the same rather, as what we saw with the bullish setup, but in reverse this time. So we're selling at the 50, our stop is above the 61.8, and we're simply looking for price to trade back down to the 23.6% retracement level, which gives us roughly a 2-to-1 return. Okay, so hopefully you can see now that this is a really simple and effective strategy that you can use to quickly profit from the market once price has made a big move. Now, as ever, the important thing with all of these strategies that we talk about in these sessions is learning to understand the conditions in which the strategy works best, and then also the conditions in which it is most challenged. So we don't want to look to operate this strategy in all markets at all times, okay? We only want to focus on a pair which has made a large impulsive move before looking to trade the correction, okay? So looking at this chart, this impulsive move stands out clearly, okay? And these are really the type of setups that you want to stick to. So you should always be thinking to yourself, does the setup jump off the screen at me and stand out immediately or not, okay? And the answer in this case is yes, it does. You can see we have a really strong impulsive move. And so identifying that directional move alerts us to the fact that we want to be on the lookout for a correction. So we apply our Fibonacci retracement, and then when we get that correction, we're looking to trade at the 50% level. Now, alternatively, when markets are in shallow, choppy conditions, where the ranges aren't very big and when the market is simply rotating higher and lower and not making any clear directional moves, well, then we want to stay away and focus on other markets, okay? So, and actually we've just got a question here, which pair suits this scalping? The answer is you really want to be looking for any pairs which are showing momentum on the day, okay? Because what we're looking for are these big directional moves and then a retracement afterward. So if you're looking at a pair and you're scalping it for a couple of days and you've got good momentum and it's trending, and then all of a sudden it dries up and it starts to range, well then don't waste your time trying to operate the strategy on that pair as it starts to range. Simply look elsewhere and find a pair that's showing good momentum and then look to operate the strategy there, okay? So as I said, to reiterate, and this really is key with all strategies, you need to learn to understand the conditions which suit the strategy best, and then look to find those conditions in the market. And then you also need to understand the conditions which challenge the strategy. And then whenever the market is displaying those conditions, you simply look elsewhere or wait for favorable conditions to show themselves, all right? And this is really key. You don't need to waste your time trying to operate the same strategy every day in the same pair. Okay, you just need to wait and identify favorable conditions and then look to operate the strategy. Okay, now as well as just trading on the basis of the move made over one day, we can also look to combine days ranges, okay, to identify these trending moves that we're talking about. So where we're talking about these large directional moves such as we've seen here, so far we've been looking at these moves made over one day, but we can also look to identify these moves over multiple days. So in this example, you can see that on the first day, we had quite a sustained sell-off in sterling, okay? So again, we're on the 5-minute chart. Each of these period separators denotes a 1 day, a 24-hour period. So you can see on this first day, the price sold off sharply. We didn't really get any substantial corrections higher, so we weren't able to apply our Fibonacci retracement and identify any retracement to the 50% level on this first day. However, you can see that we bottomed out on this second day and started to correct higher. So again, once we see price bottom out and we can identify our bearish swing, and then we can see that price is starting to correct higher, we simply go ahead and draw in our Fibonacci retracement level from the high of this first day, attaching it to the low of this second day, and then the strategy is exactly the same. We're looking for price to trade back up, test the 50% level where we're getting short. Our stop is above the 61.8 level, and we're targeting a move back down to the 23.6. So very simple again, very effective. We're simply focusing on finding these directional moves in the market, these large moves which show that there's a lot of momentum in the market, and then once we get some sort of profit taking on the move and we start to get a correction higher, we're then looking to enter expecting a resumption of the trend. Okay. So again, the skill that you need to develop here is in identifying these impulsive moves and then the subsequent corrections, because that really is at the heart of this strategy. So where the market makes a sort of straight driving move and then corrects, this is where we find the opportunity to scalp the 50% retracement level to capture the resumption of the trend. Now, for more conservative traders who find simply entering at the level too aggressive, we can also look to use candlesticks as an entry signal. So this is where we look to use price action confirmation. So far what we've been looking at doing is simply entering at the 50% level with our stop behind the 61.8% level. However, we can also use price action confirmation instead. So instead of simply entering at the level, we wait to see if price respects that level before entering. So if the candle breaks through that level, we would refrain from entering the trade. If the candle respects the level, we then go ahead and enter the trade. Now, this is a very subtle adjustment to make to the execution, to the actual strategy, but it can often help protect against instances where the market blows straight through the level. So let's take a look at an example and I'll explain. Okay, so focusing here on this period of price action. So again, we've got our big sell-off lower. We've put in our Fibonacci retracement level. Market is correcting higher. We're looking to set a short trade at the 50% retracement level. Aggressive traders can go ahead and simply set an order to sell at the 50% with a 61.8% stop, targeting a move back down to the 23.6. Conservative traders can wait for price action confirmation. And so what do we mean by that? Well, if we look at the way that price reacted here once we touched the level, you can see that as price traded up and tested the 50% retracement level, although we pierced above it very slightly, we actually reversed and closed below that level. So what that candlestick is telling us is that at that 50% retracement level, sellers stepped in and were active, okay? So bulls were in control initially. This is obviously a green candle that shows that buying is strong. Price has moved higher over the session. But as we touch this level here, sellers stepped in and drove the candle lower, and that's why we've got that long wick at the top. So once we see that happen, once that candle closes below the 50% retracement level, well then we know that sellers are active at the level. We know that the level is being respected, and so this gives us the go-ahead to enter our short trade. And we manage the trade in the same way. Our stop goes above the 61.8% level, so our stop goes above this level here, and we're simply targeting a move back down to the 23.6, which is roughly 2 to 1, depending on where you enter, obviously, with the candle close. So again, this is a way of allowing conservative traders a little bit more safety in terms of how they enter the trade, waiting for a bit more confirmation instead of just jumping in as price touches the level. And you can see here in this instance exactly how that works. So we wait for some sign that price is respecting the level, that there's been a change in order flow before entering our trade. Now, alternatively, if you look at this example, okay, so again, what we've got here is one of these big 2-day moves. So we're not just looking at the move over one day, we're looking at a strong bullish move to the top side here, where again on the first day we didn't get any significant retracement lower, allowing us to identify our correction. It wasn't until the second day where the market topped out and started to move lower that we could actually go ahead and put in our Fibonacci retracement tool, applying it from the low to the high, okay? Remember, because this is a bullish swing, we fib from the low to the high. And then the level that we're concentrating on, once again, is the 50% retracement. But this time, instead of just buying the level, we're going to wait and see if price respects the level. And you can see quite clearly here, okay? In stark contrast to what we saw in the previous example where price respected the level, this time price has blown straight through the level. So you can see this big bearish candle here, and I've highlighted in orange the section where price cuts through the 50%. So we trade straight down through that level and closed almost down at the 61.8% retracement. So if we were operating in a conservative way and waiting to see price respect the Fibonacci level, then we wouldn't have entered this trade, okay? Aggressive traders would have entered the trade buying at the 50%, and they would have been stopped out because price goes straight down and hits the 61.8. But conservative traders waiting to see if price respects the level or not wouldn't have a trade. They wouldn't have entered the market. So this is a great example of how a losing trade can be avoided by using this alternative method of execution. And again, as I mentioned at the start, with scalping, it's incredibly important to always be thinking about risk management. So this one is a fantastic way in which you can incorporate risk management into your scalping and be thinking about it in terms of how you execute your trade. So just making a slight alteration to your execution style, such as waiting for price action confirmation, as you can see, can have powerful implications for your trading results. Now, as ever, with any strategy that you intend to use, it's important to make sure that you spend the proper time testing your strategy and researching it to make sure that you're using it in the best way possible. And this doesn't just mean looking to see if you can make as many pips as possible. It also means making sure that you're protecting yourself and looking to limit your losses. Because remember, every pip that you don't lose is a pip that you don't have to make. Okay, so this is a really great example of a very slight modification you can make to how you enter a trade, which over the long run could prove to be very effective in improving your results. Because imagine if 60% of your losing trades with this strategy could be avoided by simply changing to a price action confirmation method. That would obviously greatly improve your results. So as I say, it's important to spend time checking your strategy, testing it and researching it to make sure that you're always operating in the most effective way possible. Now, while many scalping techniques focus on reversals, short-term traders can also look to take advantage of breakouts, which offer the opportunity to profit from quick, explosive moves in price, explosive continuations. So whereas with this strategy, we've been looking to trade a reversal. So for example, here, we're looking for price to trade into the 50% and reverse higher. It is also possible for scalpers to use a breakout approach where you're simply looking for price to continue in the direction it's going. And one classic strategy which utilizes this approach is trading a breakout beyond the prior day's high or low. So again, another really simple, effective strategy. And as with the retracement strategy, the beauty about this is that you can look to apply it each day, okay? So when we're trading on the lower time frames and where price is moving quickly, it's really important that our strategies are very streamlined and very straightforward. We don't want to have to consider too many different variables, okay? We don't want to be looking at several different things at once, ticking off a checklist of criteria, because hesitation is the enemy of the scalper, okay? You're operating on the lower time frames where volatility is much more pronounced, and so it's vital that you have your trade criteria crystal clear in your minds so that as soon as conditions present themselves, you can execute your trade immediately. And so in that respect, it's really important to have very simple, very straightforward strategies which through your research you've proven are effective. So in this strategy where we're looking to buy or sell above and below the day's high and lows, all we want to do is draw lines in on our charts each day highlighting the prior day's high and low, and then we're simply looking to enter a trade as price breaks either above the high or below the low. Okay, so here is an example of this then, and you can see that I've identified the prior day's high and the prior day's low. Okay, so the market opens up. Remember, these lines are denoting a 24-hour period. So the market opens up. This is a new day. We've got the prior day's high marked in here, and we've got the prior day's low marked in here. We're simply monitoring the market, looking to identify a break of either side. And so as you can see here, immediately price breaks down below the support line, so below the prior day's low, giving us an opportunity to go short. Now, in terms of our trade parameters then, typically the best way to operate this is to use a 10 pip stop and a 20 pip profit target, okay? And you can obviously play around with this and test it yourselves. You could go for 5 and 10, 15 and 25, so spend some time looking at that. But a basic one that you can use to get going is looking to use a 10 pip stop and a 20 pip profit target. And while the market can often carry on for longer than this, again, remember that the objective of the scalper is to realize profits as quickly as possible, not to capture the biggest move, okay? So looking to target 20 pips is a great level, and this will usually be achieved fairly quickly. Whereas, again, if we're looking to apply a swing trading approach where we're targeting a 200 or 300 pip move, you might need to be in the market for days and possibly weeks to get that. So again, the beauty of scalping is that we're looking to achieve our profit targets in a really short amount of time. Now again, as with the retracement strategy, we need to keep an eye on market conditions, okay? Because as I've said, and as I keep trying to reiterate, to emphasize, market conditions are really key to the success of any strategy. So if the market settles into a range whereby price is simply rotating higher and lower, and it's not making any clear directional moves, then this can be problematic for breakout traders, for momentum traders. So it's best to wait for the range to resolve and for a new trend to develop, or again, simply look at other instruments, okay? So many of the new traders that I work with get bogged down saying, you know, a strategy that they've been applying that's been working really well all of a sudden isn't working too well, and I take a look at their charts and I say, look, the problem is market conditions have changed, okay? Initially you were trading in a trend and now price has settled into a range, but don't get stuck just trying to trade the same instrument over and over because it's been working for you in the past. Simply look elsewhere, okay? Orbex offer a fantastic range of instruments and different markets that you can trade in. So your job as a trader is to identify the best conditions for your strategy and look to apply them there and look to avoid conditions which challenge your strategy. So again, when you're operating this type of strategy, you'll find that it works best in trending markets displaying strong momentum. So as ever, it's important to assess market conditions before you decide to operate this strategy. And I can see we have a question here, which indicator can you use to find momentum? Some great indicators for momentum: ADX, which is the average directional movement. You can use ATR, which is the average true range, to show you how much an instrument is typically moving. You can use the actual momentum indicator. So there are a whole host of indicators built into the Orbex MT4 platform which will highlight momentum for you. But what you really need to want to do is get to the stage where you can simply look at the charts and identify momentum based on the way that price is moving. So as I've said, where price is simply stuck in a range, rotating higher and lower, it's clear that there is no momentum, but where price is starting to move heavily in one direction, then there's obviously momentum in the market, and that's where you want to be looking to apply your strategy. So let's take a look at an example of this strategy in a trending market. Okay, so I've got a number of lines on here and a couple of numbers, so let me walk you through so it's all nice and clear. So, as I said, this is an example of this daily breakout strategy in a trending situation in the sterling dollar. So you can see that the first high I've marked, number 1, at this point here, is where price was initially moving sideways. So this is our trading range, okay? We've got our high here and our low here. Price is chopping around, but then at this point here, we break out above that prior high, and this gives us our first bullish trade. Okay, so we go ahead and mark in the prior day's high, and then as price breaks out above that level, we're simply looking to get long. So we break out above that level, we trade up and put in a new high on the day, we then correct and start to move lower, and so again we go ahead and draw in a line highlighting the day's high, the prior day's high. So market has broken out to the top side. We're anticipating that we're going to get some follow through. So we want to see market breaking out to the top side again. And at this point, you can see that we get another bullish breakout. So we've highlighted the prior day's high. We're anticipating we're going to get a bullish trade. And at this point here, price breaks out above the prior day's high and we get another bullish trade. Okay. So from that point, you can see that we get an explosive move higher up to this point here, where once again the market stalls. We fail to go any higher at this point and we start to correct lower. So when we open up the next day, once again, we've got our horizontal line drawn in. We've marked the prior day's high. And what are we doing? We're just waiting for price to take out that high and we're looking to trade a continuation higher. So again, you can see at this point here that we get another breakout to the top side and we get a further bullish trade. Now, as I said, the beauty about trading a scalping method is that we aren't looking to hold for big positions. We're only looking to hold for short moves. So where we're only looking to target 20 pips, typically you'll find that 20 pips is easily and quickly achievable when the market breaks out above these levels. So we get our breakout here, we trade up to make a new high, and then once again we start to correct lower and form this small block of consolidation. So when we open up the next day, what do? Again, we just enter in the prior day's high as this nice horizontal level. Okay, so you can apply these lines yourself using your MT4 platform. You simply put in this line, and then once more we're just waiting for price to break out above the day's high, which you can see it does once again at this point here. And look, this is another great example of what I've been saying, which is where the benefit of scalping is that you don't need to be right about the overall direction. You're just looking for a quick move. Okay, so on this day we broke out above the prior day's high, we banked our 20 pips and we were out of the market before ultimately it reversed lower on the day. And then once again, finally, you can see that we put in our prior day's high, a nice horizontal level, and then we're waiting for price to take off above that high. And so there we go. We get our 5th trade in that series. So again, another really simple, straightforward strategy that can yield powerful results in the right conditions. So we've identified bullish trend conditions. We're looking to take bullish trades. And there we've got 5 winning trades in as many days. So another really fantastic strategy, scalping strategy, that you can use to get going. So again, these are just a couple of the ways that you can look to trade the market. The idea is to give you a nice look at some classic foundational strategies that you can use to approach the market as a scalper. And as I said, the beauty of scalping is that you can really apply a whole host of different methods. But the key thing is you're trading on the lower time frames and you're only looking for quick reactions instead of having to take a broader directional view of the market. And this allows you to be opportunistic and to make profits quickly. Okay? When you're scalping, you don't need to know where the next 500 pip move in the euro is coming from over the next several weeks. You only need to know where the next 10 pips is coming from, and you just need to learn to highlight a few basic setups that can allow you to capture these moves quickly. And this is what makes scalping so incredibly attractive for a lot of traders, and also so incredibly lucrative for those traders who are willing to spend the time developing their strategies and perfecting the art of scalping. Okay, so I hope that you found today's session interesting and that you're excited to get onto your charts and practice your scalping. Before I go, are there any questions that I can answer for anyone? Brilliant. Okay, well, thanks a lot. I'm glad that you've all enjoyed that and found that useful. And I look forward to catching up with you all in the next session. Guys, getting a lot of good responses for this, so I'm really pleased that you've all enjoyed that session and found it useful. Again, really look forward to catching up with you all next time. Thanks a lot, everyone. Best of luck with your trading. Take care.